Hello, now can you hear me? Okay. Okay, so good afternoon everyone. So my name is Aaron and this is my teammate Zachary and Hannah and Jia Yi. Jia Yi is not here. So today we're gonna present Genting Plantation VSRI corporate company for their financial analysis. So this is our table of content: introduction, pastel, SWOT, portal, 5 force, horizontal, vertical, ratio, finding, recommendation, and conclusion. Go. And this is introduction. So I will pass to Zach. Okay.
Okay, so Genting Plantations Berhad, or also known as GenP, is a major palm oil producer in Malaysia, and it's a subsidiary of Genting Group, which is also a conglomerate. Basically, they have other things they do in different industries. So they were incorporated in 1980 and it's listed on Bursa Malaysia's main market, which establishes their presence in the environment. So they manage over 243,000 hectares of plantations in Malaysia, as well as Indonesia, and their main focus is on palm oil and their production of CPOs, as well as palm kernels. So beyond palm oil, GenP actually expanded into refined oils, biotechnology, renewable energy, and even property development, creating value throughout their supply chain. So in the financial year of 2025, the first quarter of this year actually, they saw a 19% increase in revenue, up to 719.5 million, with a net profit of 61.3 million. So it's important to note that the palm oil industry plays a significant role in Malaysia, the economy especially, but remains highly sensitive to global price volatility. So this means that it can indirectly affect the company's performance in the long run.
So I will cover SWOT analysis, which is a strategic planning tool that is used to identify and evaluate the strengths, weaknesses, opportunities, as well as the threats of the business for decision making. And also strategy formulation by providing a clearer picture of the internal and external factors. So in this context, the following is a SWOT analysis that is done on Genting plantations. So all in all, GenP faces strategic challenges and opportunities that is shaped by the economic, industrial, as well as business environments. Economically, fluctuations in crude palm oil prices, driven by global inflation and interest rate changes, expose the group to margin pressures, highlighting the need for continuous cost optimization. Industrially, increasing regulatory scrutiny on sustainability, especially in regions like Europe, necessitates the adherence to certifications, such as the sustainability certifications in the palm oil industry, while the agricultural technology innovations like the Internet of Things, monitoring, and also the geospatial analysis enhance operational efficiency as well as decision making. From a business perspective, GenP can leverage its sustainability credentials to enter environmentally conscious markets and reduce dependence on Malaysia and Indonesia only, thereby mitigating their regional risk and also unlocking new opportunities as well. So I'll pass it to...
Okay, so now I'm gonna talk about Portal 5 force. So 5 force, right? First force, threat of new entrants. So the assessment is moderate to high. The key entry barriers here is high capital investment. So significant funds needed for the lands, infrastructure is high. Need money, right? And then long gestation period. So planting a palm oil is not easy. It needs 3 years to yield and 5 years to fully grown to have fruits. And then the third is land scarcity and regulation. Difficult landscape expansion due to environment rules. So Malaysia is very, and specialized expertise requires specific agriculture and operation know-how to plant a palm oil. So next. So the second force is bargaining power of buyers. So assessment also moderate to high. Factors contributing to buyer powers. Commodity nature, palm oil is undifferentiated, allowing buyers to switch supplies. So not only palm oil, like sunflower oil, got a lot of oil, right? And then substantial demands, buyer demands certificate substantial palm oil like RSPO, MSPO, ISPO, increasing leverage. So need a lot of stock available for substitutes. Or other vegetable oils provide alternative, enhancing buyer leverage. So the next is bargaining power of supplies, low to moderate. So factors limiting supplier powers. So fragmentation market, numerous suppliers for agriculture input, fertilities and machinery. And GNP purchasing volume, substantial scale provides negotiation leverage. And the last is labor, while critical mechanization effort aim to reduce dependency, dependency and influence. Okay, cool. And the fourth will be substitute produce and trade-off substitute produce our service. So the assessment is moderate. Primary substitute is soybean, sunflowers, and rapeseed oils. So influence factor is consumer preference and health concern can shift demand away from palm oils. Palm oils is not healthy, actually. So negative publicity. So anti-palm oil campaign impact brands' image. And government policies favoring domestic oil seeds can encourage substitutes. And last but not least, palm oil counter advantage. Cost effective and high yield per hectares maintain competitive edge. So last, intensity of rivalry. So the assessment is high, so factor driving high rivalry is numerous competitors like IOI group, obviously, and large and small producer, especially in Malaysia and Indonesia. So commodity products, CPO undifferentiated nature leads to intense price competition in the world and in Southeast Asia. So high fixed cost, incentive food production, exacerbating price was during oversupply. So global export markets produce compete fiercely for international market share. So this is all the quarter 5 force, and now we'll go to horizontal analysis. Still me, yes. Comparative financial trends first. So revenue and scale for IOI group, because we are comparing to IOI group, right? So it's significantly larger but face steeper revenue decline. So GNP show better revenue stabilized in financial year 2024. So profitability diverged. Both face profit drops of 2023. GNP achieved a strong 26 net profit rebound in 2024. Leveraging CPO price recover, and also IOI Group's net profit continued to decline due to failing realized CPO price. So Genting is earning money. So asset growth and investment, both companies grew asset in financial year 2024, and with GNP showing higher proportion of growth, indicating more aggressive and capital development. Also, this is part 2. Cash from operation, both experienced significant decline in operation cash flow in 2024, highlighting industry-wide challenge. So cash from financing, GNP strategically raised substantial capital while Sukuk in assurance in FY24, 2024, leading a net cash flow. IOI Group consistently used financial for outflow, debt and dividends. Last, CPO price impact. GNP successfully capitalized on the CPO price rebound in FY 2024, whereas IOI Group realized price continued to decline, impacting the profits. And now I'm gonna pass to Zach for the vertical analysis.
Alright, so a vertical analysis gives us the perspective of GNP's cost structure, profitability, and financial condition by expressing each income statement item as a percentage of their total revenue. So as we look at financial year 2022, they received a revenue of 3.19 billion with a net profit of up to 471.4 million, with a net margin of around 15% due to their high crude palm oil prices and effective cost control. So despite this success, IOI Corporation still had stronger capital efficiency and higher returns compared to GNP. And in the financial year of 2024, revenue was up to 2.94 billion. The cost of sales was around 89% with a gross margin of up to 11%. but a net profit of 335 million with a net margin of around 11%. So in this financial year, it actually showed marginal improvement despite the slight revenue decrease in the previous year. So in the first quarter of this year, 2025, revenue was up 19% to 719.5 million, with a net profit of 61.3 million and a net margin of around 8.5%. So the return on capital employed improved from 5.5% by the end of 2023 to 6.9% by mid-2024. But this is still below the industry average of 8% and well below IOI's 11%, which still suggests that they have room to improve, especially in their capital utilization. So overall, GenP's operating cash flow turned positive to 103 million in the first quarter of this year. I'll be passing time.
So I will cover the ratio analysis, which is a financial tool that is used to evaluate the company's performance as well as the financial health by analyzing relationships between various financial statement figures. So in this context, we did a comparison against a competitor of the same industry, which is IOI. So across the past 3 years, from 2022 to 2024, innovation analysis that we've done from all in all, IOI Corporation has consistently outperformed Genting Plantations across key financial metrics, showcasing more stable profitability, efficiency, as well as financial stability. So IOI maintained higher and more stable net margins, return on equity as well as return on assets, supported by solid cash flow and a conservative capital structure. In contrast, GenP faced rising leverage, weakening liquidity, and also declining operational efficiency. While they had some modest improvements in profitability and dividend payouts in 2024, as shared by Aaron earlier on, IOI's diversified operations and also prudent financial management provided resilience against the market volatility, while GenP's concentrated model and also their cash flow constraints highlight the need for greater efficiency and tighter capital control to close the performance gap. I'll pass it back to
So this is the final conclusion. Since Jay is not here, I will talk about a bit of recommendation. So for conclusion for our financial analysis, financial performance for GenP show resilience and recover in 2024, but fall behind competitors like IOI Corporation Berhad. But because IOI is a bigger palm oil company, bigger than GenP, therefore they have higher profit margin. So strength and weakness, GenP has a strong capital base and edge tech adoption, but face challenge with geography concentration and high costs because use too much technology. And the recommendation, this is J parts, and I will cover a bit. So for recommendation for GenP is enhanced asset utilization, strategic investment, advanced precision agriculture, diversification, supply chain optimization, cost control, and ESG leadership. This is from Jay. I know it's too much. Okay, thank you very much.